So let's get back to the global space markets mayhem on a Monday. Of course, is on everyone's face. We're starting today, not looking really good for the Asian market. Still feeling the sneeze of yesterday. Well, of course, we'll discuss a little bit more of that later on the program. But the key question: did we miss the warning signs, the red flags, before yesterday? Nasty markets finishing, of course. Let's ask Uchenna Minis, who is the chief markets analyst at Eagle Global Markets. He's live to us from our studios at the Nigerian Stock Exchange. Good morning, Uchenna.
Good morning, Bolson.
Yeah, thank you. Last Friday, I think Thursday, Friday, we were sharing some of these thoughts about what the weather conditions, the headwinds that were coming, and just about a few days after where we were yesterday, with very nasty way in which the market was roiled. Perhaps no one expected what the Chinese did with the yuan and the reactions from President Trump from the White House. So my key question: did we miss the warning signs, the red flags? Had they all been there? Did the market not price that in before?
Boston, it was quite clear that those signs were really evident. But you get to that point where people are overwhelmed with greed, and that was really what happened with the market yesterday. If you really check it, in the beginning of the year, since we had the December plunge, what has literally driven the market is just basically hope-driven rally by fake rhetorics from Washington as regards to the successful trade negotiations with China, and also the possibility of a Fed looking to start a cutting cycle. Now, those two variables have literally been nullified. Those two variables have been nullified. Now, the investors or those buyers that were really riding that wave upwards have nothing to hold on to, and that's why we saw those significant dip from yesterday.
So what did it tell you about where the whole situation is going? Morgan Stanley had always maintained a bit more of a pessimistic view of things. Morgan Stanley, one of the biggest banks in the world and of course in the US, says recession will likely come in the next 9 months. Technically, on or before June next year. Says crude prices could fall as much as $30 a barrel if the current trade fight continues.
This risk has actually been cited by us in the beginning of the year, highlighting how the trade war and the escalation of trade war would continue to drive down global growth. It is really going to be a significant issue going forward. Recessionary risk, literally, there are so many indications of recessionary risk. Right now, the world has about 14 trillion debt that are yielding negatively. 14 trillion yielding negatively. You have Germany in technical recession. You have Italy also having some significant slowdown. The Eurozone also slowing down. Banks are looking to cut interest rates. A lot of banks have started their own easing cycle. So it's clearly evident. But the truth of the matter is, when you have investors just looking not to miss out on the rally, we call it fear of missing out, the FOMO, they continue to just price in those optimistic views, whereas it has been baseless. So basically what we are looking at is we are looking at the recessionary risk looking to materialize going forward if this trade will continue to brew. And I don't think this is now a case of Trump's ego, really. And the Chinese have looked at it and they've considered that they would just need to weigh this out to understand that by the time the new general election comes in the next year, it's either Trump gets in or the Democrats get in. And for them, that's a win-win situation, because then they have a better hand to negotiate. They would really like the Democrats to get in so they can come to a neutral table where they can have those conversations. But right now, Trump is really, I'm thinking, is actually in a place of implosion, really, because everything that he has looked to plan is coming back to bite him.
Okay, so what does the current situation mean for the markets and for interest rates? September is another key month ahead of us in terms of where monetary policy conditions or decisions will be taken. We've seen a bit of easing. It looks like a little bit like, look, central banks around the world are either going to cut very gently or they're going to hold rates at the current position, because as the saying goes, no one knows tomorrow.
Yeah, I remember last time I told you that the Federal Reserve has sort of tilted from being the central bank of the US and now central bank of the world. So all eyes going to be on the Federal Reserve coming September, and it's going to be a difficult thing for them to really sell to the market, because now they need to consider this selling off, and they also need to consider the US economy for itself. As I mentioned, intrinsically, the US economy is not slowing down. There is a significant differential between the US and the rest of the world. However, the Fed also needs to consider the global or external headwind risk, and which is majorly the issue. So I don't really envy Jerome Powell right now as regards to what he will do September. He also needs to consider that if he decides to start cutting rate now, so if he cuts in September, that's the beginning of a cutting cycle. And they have just 2.25 basis point basically to work with. And if that is the case, then when the recession materializes, how much ammunition do you have to fight it? So he has to be really, should I say, cautious and also wise in making this decision. So September is going to be like a key determinant as to what central banks will do going forward, following what the Federal Reserve will do. The ECB has highlighted that they would look to start up its bond buying program. The ECB don't have interest rate ammunition to even play with in the first place, so they really would be following the lead of the Federal Reserve. So come September, we would have that clearer, should I say, picture as to what the central banks will look to do going forward.
I agree with you. Whatever happens in September will determine whether we'll have a very good year end for 2019. It's between now and September. Whatever happens in September, then it's either we say happy year ending, or we just kiss the year goodbye. Whatever happens in September, we're going to roll that into Q4. Then, of course, then we begin to prepare for the year 2020, a very important year in everyone's crosshairs, importantly for Nigeria. But where do you see the emerging markets and frontier markets in this trade fight between the big boys, US, China, Europe, Mexico, Japan, South Korea? August 28th or so is also set for Japan removing South Korea from its white list, as it were. It looks like it's a whole a lot of booby traps out there.
Yeah, so for emerging markets, we can just liken the situation to where the grass where two elephants are fighting, really, and then the grass would suffer. That's just it. There is no other way around it. When these two behemoth of economies get to continue to escalate trade war, you would have that ripple effect coming into emerging market space. And you should also understand that the yuan depreciated against the US dollar to above 7.00. That is an 11-month high. It has never crossed that for that long, and that is quite significant. And that ripple effect from China having that depreciation would have that downside risk being priced into emerging market. I don't see any very optimistic view for emerging markets. And we also need to consider the effect of carry trade. As you know, the US rest of the world differential would always cause portfolio will be moved into the US, and that would put the US in a threatening place, and that will also affect emerging market, as most of their foreign debts are in the US dollar. So I don't see any optimistic view for emerging market given this Q4, even up until the first quarter of 2020. So I think we should be bracing up for a gloomy month ahead.
Okay, a final word for Nigeria in the entire markets mayhem.
We have oil trading lower, and it's also as a result of this increased global recessionary risk. And when our oil or our dependence on oil is not longer our stronghold, then it puts us in a very difficult place. I was mentioning to some people that if we see oil start trading below $30, as what we have looked at in the beginning of the year, that can automatically kick out into a recessionary phase. That's how reliant we are on oil. So we have to now start bracing to mitigate the possible downside risk going forward if things continue to deteriorate.
Thank you so much for coming through with us on the show today. Uchenna Minis, we appreciate your time from our studios at the Stock Exchange. Do have a great day. Chief Markets Analyst at Eagle Global Markets. Just a quick reminder that the Central Bank of Nigeria has issued a new guidelines around disclosure and transparency, consumer protection rules for those who do financial services in Nigeria, not just banks, microfinance banks, finance houses, everyone in the business of financial services, including those folks in the telecommunications who are joining Broad Street providing financial services. This is an 18-page document that we advise everyone to read in details from the Central Bank of Nigeria. It outlines what you need to know about the business of credit, what the banks need to know about you, but more importantly, what you need to know, the documents you need to have from your financial service provider, what needs to be disclosed, what needs to be said in advertisements on radio and television, including newspapers. The central bank is setting the rules now that the financial services will get a lot more competitive, with telecommunications giants such as MTN obtaining a license to run financial services, fintech, and more will join the bandwagon. This is something very important. We're advising our viewers to please take time to go on the website of the Central Bank of Nigeria and read up on this 18-page document. You need someone else to explain it to you? Please do so. So let's get back to the global space. It looks like calm is returning to the marketplace, at least in Europe as we speak. All the major stock indices are in great territory as we speak. It's early morning yet. Well, it's still around night it's not yet early morning hours yet in US. So perhaps President Trump is still in bed, most likely. So he hasn't tweeted today. I haven't seen anyone of that. So it looks like things are a bit quiet right now.